Welcome back and welcome to the Q&A portion of our Capital Markets Day. I'm joined by my team who presented today, with one exception. Keith Choi, our head of Asia Pac, broadcasted his presentation from Singapore. So as a result, he's not here with us today. Before we get started, I do want to comment on the shocking and tragic events in Ukraine. Our focus is supporting our people in Ukraine and for their safety. We're also involved in initial release efforts and engaged in NGOs like Saving the Children and in key UN agencies. There's no justification for the invasion and the harm that that's doing to the people in Ukraine. I personally hope for a quick and peaceful resolution. So let's move on to the Q&A. As Sonia said earlier, the Q&A is going to be over the phone, but also on the online platform. So I see that we already have questions from the online platform, so I'll start there and I'll move to the phone calls later. So the first question. The business has historically delivered growth below 4.4% CAGR for 19 to 21. How confident are you that you can sustain this higher level of growth and your 4 to 6% medium-term going forward target? Well, first, let me say I am very confident in the 4 to 6% medium-term target we gave today, along with the other outlooks that we gave. One of the reasons for that confidence is the fact that we grew this business 4.4% over the last 2 years with a net COVID headwind, and while we were doing an integration, planning for a separation, all during a pandemic. Now, if you look at the historical performance of this business, the last 2 years are the most relevant. Those are the 2 years where we had the portfolio that we will take forward as Haleon. And as Tobias took you through in his presentation, there's been a massive transformation in that portfolio. We've entered the vitamin mineral supplement category, which is a faster growing category and even more relevant with the pandemic and with a leadership position. We've significantly increased scale in the 2 largest markets in the world and have leadership positions in US and China. And we've also divested 50 growth dilutive brands. So starting with that portfolio, with what we've outlined today and our competitive capabilities, our clear strategy to drive growth and our sources of growth around penetration, around expansion of channel, geography, and portfolio, along with our sustainable model, which allows us to invest in growth and invest in A&P and R&D as we move forward, makes me extremely confident, and I'll speak for my team, in delivering that 4 to 6% medium-term outlook going forward. Okay, looks like we have another question from the platform. You have a great portfolio of power brands. Can you elaborate on the role of local strategic brands play? And is there ambition to convert them to power brands over time? First, talking about power brands, we have 9 power brands, as you know. 60% of our sales account for 80% of our growth. Now, these are brands with significant scale. They're in multiple markets around the world with significant distribution. They have higher gross margins and very strong equities and a right to win. But they are complemented with our local strategic brands that we talked earlier in their own right are iconic and very strong brands and very strong equities. And many of those brands are really driving growth in local markets. In the last year, we had double-digit growth on brands like Tums in the US or Bactroban in China or Grandpa in South Africa. And we have penetration opportunities across those brands along with the power brands. Now, that said, we have no necessarily stated strategy or ambition to increase the number of power brands over time, but we're always looking for opportunities for portfolio expansion and taking brands to additional markets where we see the opportunities arise. Okay. Looks like we have one more question from the platform, and then I'll go to the phone. What will you lose by not being part of GSK? Well, the first thing I would say is, listen, in the last 7 years, while we were a part of GSK, the portfolio transformation that I talked about happened. We were able to do 2 of the largest transactions in the sector in the last 7 years, and that created this portfolio that we're now talking about. So I'd say GSK and now Pfizer have been great owners of this business. That said, I think this is more about what we can do going forward and not about what we're losing from GSK. This is a great business, and the opportunity in front of us is to create our own distinct consumer-centric and performance-driven culture. It's about even sharpening our focus on growth. We have an opportunity to streamline systems and processes that are more fit for purpose for a consumer company and help drive more agility in our business. And of course, as a business of 10 billion pounds, it's right that we have our own capital allocation priorities going forward. And as we said earlier, our number one priority for capital allocation is to invest in the business and drive growth. Okay, I think we have a question from the phone.
Yes, our first question from the phone is coming from Guillaume Delmas from UBS. Please go ahead.
Thank you very much, and afternoon all.
Afternoon.
A couple of questions for me, please. The first one is on the foreign exchange impact you referred to, which was one of the factors preventing you from achieving around 25% operating margin last year. So I was wondering, could you shed some light on what seems to be a recurring negative transactional impact coming from FX? And I guess more importantly, going forward, should we model a continuous FX drag on your margin development? And I've also noted that your medium-term margin guidance is in constant currency. So does it mean that on a reported currency basis, your margins could actually go backwards in certain years? And then my second question is on your geographical split. I mean, you are combining EMEA and Latin America. This is a relatively unusual combination. So wondering the rationale behind this. Is it just down to having the strong price-led growth in LATAM, partly compensating for the muted growth in Western Europe, or any other reasons behind that? And I guess if I can squeeze one more in, more for Filippo. If we exclude North America, I get a 2019-2021 CAGR of 1% for your mature market. So do you think you can accelerate your growth in Western Europe, or is flat to low single digits a realistic ambition there? Thank you.
Great, thank you for the question. So what we'll do is, Tobias, maybe you can first address the FX question, and Filippo, I'll come to you for the two questions, the EMEA, LATAM, and the question on growth.
Sure. Good.
Tobias?
Yeah, thank you, Brian. So as you've seen in my presentation, we had a negative currency impact of 1 percentage point between 2019 and 2021. But you've also seen through the strong operating leverage that we've driven through that period that we more than offset those headwinds. Look, going forward, I can't speculate on what currencies are going to do. I think 2021, is a good base for what we expect to happen in 2021. But again, look, with recent events, very hard to predict. And what we're going to do going forward is we'll give you more guidance on what currencies are moving. Maybe just if you take a bit of a step back, our biggest foreign currency is the US dollar. That's where, both from a sales and also from a cost perspective, it's our largest business, with local manufacturing also in the region. The second currency is the euro, given we have a strong presence in Europe, again, both from a sales and also from a manufacturing base. Then the third one is the Chinese RMB, given China is our second largest business. And also here, I think a good balance because we manufacture locally and also R&D. And then from a pound sterling point of view, large cost base, but not that much sales. And then the fourth currency is probably the Swiss franc, given we have our categories and also production there. So I think overall a bit of natural protection, but again, I couldn't speculate what currencies would do into the future.
Okay, thank you, Tobias. Filippo.
Yeah, thank you, Brian. Let me start by the question about the setup of the region. So we have a balanced region with 44% in developing market and 56% in developed market. Now, I personally see a benefit in having realities like LATAM, Middle East, Africa versus the most mature market. Why is that? For some reason. So first of all, there is a mutual benefit in leveraging the learnings and the key success factors from both ways, because we have countries in different life stages, and therefore more developing countries can really benefit from the learnings from the more mature ones. But also, if I look into the developing markets, we have a lot of success stories. So if you look at what we've been able to achieve in Middle East Africa, there are a lot of great learnings that can be scaled up for the benefit of the rest of the region. So I'm very confident that this is a positive setup and there is a mutual benefit, as I said. Now, to the second question, which is more about West Europe. So Western Europe is part of our developed market. When you look at the last 3 years, so the CAGR of Western Europe is in low single digit growth. So it is in growth. Of course, the dynamic of Western Europe, as you know, are different from developing market. But what I think it's important to notice is that we have scale in Western Europe. We have a strong portfolio of brands which are leading a very strong leadership competitive position. And the scale of Western Europe allow us to be competitive in Western Europe. That said, final comment, I still believe Western Europe comes with growth opportunities because when you saw my presentation about Sensodyne, about Voltaren, or about VMS, it is clear that penetration opportunities is still valid in the Western Europe countries. It's not only valid for the most developing ones.
Okay, thank you, Filippo. We'll stay with another question on the phone, please.
Our next question is coming from Ian Simpson from Barclays. Please go ahead.
Good afternoon, Brian. 2 questions from me, please. Firstly, what are distribution and logistics costs as a proportion of sales? Do you book those in COGS or other SG&A? And then secondly, just thinking about RX to OTC, are you able to give any indication as to what those switches you expect in a few years' time are? Are they currently parent GSK brands or any commentary on category? And sticking with that theme of RX to OTC switching, Voltaren has clearly gone very well. How much has Voltaren contributed to group organic sales growth in the last 2 years, please? Thank you.
Great, thank you. I'm going to go back to Tobias after I answer the other 2 questions, Tobias, if okay, on the distribution costs. So on the RX OTC switch, what we laid out is that we have 2 switches in the pipeline. As I said, each one we would think would impact about a point of sales in any given year, and it is not included in our medium-term guidance. We aren't sharing the details of the switches and what they are for competitive reasons, and that's because they aren't in the public domain, and we want to keep it that way as we work to deliver those switches. And I feel great about our ability to deliver the switches, not only from a commercial perspective, certainly from an R&D perspective, as Frank took you through our capabilities there. On Voltaren, it was a very successful switch in the US, but there's a bit of a dynamic on the incremental sales that were delivered. As part of the deal, the joint venture with Novartis and GSK, what came over was the RX Voltaren MU gel product. And we had a licensing deal with Endo, who distributed that. So we did book sales on Voltaren MU gel in the US business in 2019. So when we did the switch, that RX product came off the market. So the incremental sales driven by that business wasn't fully realized by the business because we lost some revenue from the RX product. So long story short, if you look at the impact of that switch on our growth rate over the last 2-year CAGR, it's about 20 to 30 basis points up to the positive, but the switch was much bigger than that and much more important than that in the marketplace and for our consumers. Tobias?
Yeah,
question on distribution.
Ian, on the distribution logistics costs. So we have the costs, the final step of the logistics chain, so shipping to our customers and retailers are in other SG&A. Those are around 3% of revenue for us. All the costs in logistics to move the product between manufacturing sites or getting active ingredients shipped to us in our manufacturing site sit in cost of goods sold.
Okay, thanks, Tobias. We'll take one more question from the phone.
Our next question is coming from Martin Deboo from Jefferies. Please go ahead.
Yeah, afternoon, everybody. Martin de Boer, Jefferies. I think my question is essentially the same as the first one that came online around the upgrade to the growth guidance. But rather than get you to repeat your answer, let me ask it in a different way. If you look at the difference in the build-up of the guidance from what you said at the Expand conference last year, it's coming principally from a much higher rate of growth expectation on VMS and somewhat, I think, from a higher rate of growth on oral care. So I just want to push you a bit harder on those, particularly VMS. I sort of heard Tobias's comments on VMS, but you'll appreciate, A, that VMS has probably been a hard category to read through COVID. And secondly, it's a category that's attracting a lot of competitive entry, not least from Unilever and Nestle. So I think the essential question is what drives your confidence in VMS being A, growth accretive, and B, growthier than you thought it was a year ago? And a supplementary on a different topic would be the A&P ratio is notably high, and that's good. But I think given it's an important number, can I just ask, is there anything unusual in your accounting for A&P due to relative to the peer group that might account for the difference, or is that a good, clean number?
Great. Thank you. Thank you, Martin. So first on the growth outlook and the things that we've said today around channel growth, emerging market growth, and then VMS and oral health, which we said mid to high single digits. You asked about VMS, Martin, and I'll get there. I just want to comment on oral health first. If you look at the history of our oral health business, we've been able to grow that in the mid to high single digits and often high single digits. The last 2 years, it's been mid single digits. Part of that is because while we continue to see strength in our Sensodyne and Parodontax and toothpaste portfolio, there has been a negative impact on denture care as lockdowns have kept people and consumers from socializing as much, and certainly that's an older population and with cost pressures. So we saw a drag of growth that we see coming back, and we expect to come back. We're very, very confident in our therapeutic oral health care strategy, the brands we have, and our ability to drive really good growth there. On VMS, if you look at the dynamics the last couple years, last year, the category grew double digits. Let me take that back. 2020, so no longer last year, 2020, the category grew double digits in the low teens, and we grew 19%. So we had a really good year in our VMS portfolio. This year, the category came back to a kind of a low single-digit growth on that base, and we grew mid-single digits. We believe that category will grow 4 to 5% growing forward. It didn't go backwards from the big spike we had last year, and what we see in the data is in 2020, where we have full year data, 22% more people engaged in that category. And this consumer behavior of being more interested in proactively managing their health is real. And we see that across our portfolio. And we also see tremendous opportunity in our immunity brand, Emergency, in the US. There is a lot of competition happening in the space. There's no question about it. I think that just reinforces the attractiveness of the space. And many of those competitors we compete with today in oral health, where we compete with big FMCG companies that are very respected and very strong at what they do. So I feel really good about it. And basically because of our brands, our brand strength, and our ability to drive that growth. And back to some information Filippo gave you earlier is we also see this as a massive opportunity in Middle East, Africa, and in other regions to really expand that portfolio geographically. With that, I think, Tobias, I go back to you on the original question.
Good. Yeah, and Martin, on your A&P question. So, I mean, health warning first. I think it's always very hard to compare line item accounting across companies because it's very hard to see what goes in there and what doesn't. I think we feel our A&P is at the right level it needs to be. What might be a little bit different from us is I think we also have a large expert channel. So we're detailing and promote to experts. That might be different than what other companies have. So that's where a difference could be. The vast majority in our A&P spend is media, is the spend that goes in front of the consumer. So I think overall I feel good about that. And also I think if I just take a step back, when you think about the model that we laid out, for us it's about growing A&P ahead of the rate of sales growth, as we've done in the last 2 years. We've grown A&P at 6% and driven 4.4% sales growth. That's the model we want to drive going forward as well. So we're not looking to hit a certain A&P level in percent of sales, but continue this model and the growth engine to grow A&P out of sales in order to grow sales at the 4% to 6% outlook that we have given.
Thank you, Tobias. We'll take a question from the platform. The question is, could you share why it is a strength or a weakness to have a stronger presence in pharmacies in Europe, which I understand is a fragmented market, versus a more mass market-oriented U.S.? What is the impact on growth, price margin? That would be helpful. Thank you. Thanks for the question. First of all, Filippo, I'll ask you to comment on that. I would just say overall, do believe it is a good thing and a strength in our business that we have a pharmacy-driven business in Europe. But Filippo, you want to provide some context?
Yeah, thank you. So definitely, I believe it is a strength, and the reason is for a couple of reasons for that. So first of all, it is a channel which over the last 3 years has been growing despite all the changes in terms of landscape in the different countries. And second, it's a channel which has been evolving because if you look at our e-commerce business, e-pharmacies is the number one driver. So it's a channel which is in transformation, which is still relevant because let's not forget that pharmacist is the first point of care for most of the consumers, not only in Europe, but also across the region. So it's a relevant channel. But then if we look at our presence in the channel. So the channel accounts for 60% of our sales. It's our number one channel. We have a strong scale and footprint. Just to give you some data point, we are 1.6 times bigger than the second OTC competitor in the channel. We have reached 85% weighted distribution across the region, not only in Europe. And the reason why we are successful is because I think we have a very effective integrated model where it's not only about key account management or point of sales effectiveness, but it's also about expert engagement, which is something I cover in my presentation. And the three things put together, plus the scale, plus also the way we've been evolving the approach and how we support pharmacists, and you saw that in the video I presented before, makes us confident that we can still outperform the market and make the channel relevant for the future.
Thank you, Filippo. Looks like we have another question from the platform. What is your M&A strategy going to be? You will start off with a 4 times leverage, so you won't have much space to do acquisitions. How much is your budget per year? So first of all, I would start by saying we have a fantastic portfolio. And remember, this is a business that's been created by the 2 largest transactions in the sector in the last 7 years. So I feel great about the portfolio we have, and all the outlooks we've given today do not require M&A to do that at all. That said, as Tobias laid out, we have 4 times leverage and a plan to get that below 3 by 2024. And within that, we do have some capacity for bolt-on M&A over the next 2 years. But maybe, Tobias, you can provide some additional perspective.
Yeah, so thanks, Brian. So maybe let me take a step back. And when you look at the cash flows that I presented today, we had around 1.5 billion of cash flow per year. So the cash flow of this business is very strong. It has high cash conversion, and we expect that to continue into the future. And with that, I think that gives me and us as a team the confidence that we can fulfill all the capital allocation priorities, which is investing in the business, paying the dividend, doing bolt-on M&A, while meeting the deleveraging targets, and also all across that, maintaining a strong investment-grade balance sheet along the way, and from the outset, right at the demerger.
Thanks, Tobias. Let's go back to the phone lines.
Our next question is coming from Tom Sykes from Deutsche Bank. Please go ahead.
Yeah, thank you. Good afternoon, everybody. I wondered if you could just give some indication of the relative gross margins in the different categories? And when you talk about gross margin expansion going forward, is that mix related, or what other impacts are you expecting at the gross margin level, please?
Okay, thank you for the question. Tobias?
Yeah, thanks for the question, Tom. So from a gross margin perspective, I would say that the categories in aggregate, I think, are broadly similar. But VMS is slightly less, but the others, I think, very much comparable. So I don't think there is a major mix impact from the growth forecast we have given by category in our presentations today. We see the mix improvement coming from a shift to power brands. Power brands have been and will be a key driver for growth, and power brands tend to have higher margins. Also, looking at the scale they have for the business. So I think from that perspective, not that much difference. And then also, I think you have to take into account in the A&P allocations we do. So we tend to look at the business on a brand contribution level, gross margin minus the A&P that we directly invest in the business. And I think that is broadly similar across all of the categories.
Great. Thank you, Tobias. Let's go back to the phones for another question.
Our next question is coming from Chris Pitcher from Redburn. Please go ahead.
Thanks very much. First question is a bit of a follow-up to the one you've just had there. You mentioned the power brands are higher gross margin, and therefore I would expect from your comments they would be higher A&P. Does your growth in A&P over the last few years, is that just a function of mix going towards bigger power brands with higher investment, or actually have you seen the rate of investment increase on your power brands and going forward? And then secondly, can you give us some sense of the economics of healthcare professional advocacy, how that compares with trying to build consumer brand awareness and demand? And as e-commerce increases its importance, does that reduce the ability for professional recommendation?
Great, thank you, Chris. First of all, I'll just comment on the A&P investment. The A&P investment both is a bit of mix, but it's actual more investment in brands, in markets. So as we think about brand market combinations, where the growth opportunities are, within that we're very focused on ROI and making sure we get that return. And we've had quite a shift to digital, which we find ROI is higher. But it's a mix of both. And maybe, Tamara, if you would comment a little bit about what we've seen on improved ROI and how we're doing A&P allocation.
Yeah, sure, Brian. So, very clearly we have, I think, the right level of A&P for our sector. We then make sure we deploy that very strategically. So against our enterprise strategy, looking at our strength and our opportunities and what's happening externally in the market, as well as trends. And then we are very focused on improving and always getting attractive ROIs. And we've had quite a significant increase over the last few years around how we use sort of digital data and analytics, the tools that we've got at our disposal. So our marketing teams are able to pre-test creative before it goes live. That's had a significant increase in brand recognition and also purchase intent. We've also been using really good data-based audience profiling tools. So we have a cloud-based platform called People Cloud. We've used that across 16 markets. And as you said, Brian, really increasing our ROI. So we've seen a 40% lift in ROI on our digital work and also a 125% lift on our traditional work. So we really have been driving the better use of our investment as we deploy it strategically against our brands.
Thank you, Tamara. Chris, to your other questions on the economics of healthcare professionals, the economics are very good, and we have clear ROI metrics on it. And just to give you a perspective, we know that 70% of the trial in our oral health comes from a healthcare professional, and that has a very good return for us. The other thing is our healthcare professional spending is also part of our A&P spend. So that sits in our A&P spend because that's how we think about that. With the shift to e-commerce, we don't see this changing the dynamics of the impact of healthcare professionals. Consumers are still looking for that recommendation, and then they're moving to make a purchase. And where they make that purchase is much less relevant than the recommendation they get. So we see this continuing to be a strong part of our of our strategy going forward, and one that we feel like we're really differentiated in. Okay, one more question from the phone, and we'll go back to the online.
Our next question is coming from Graham Perry from Bank of America. Please go ahead.
Great, thanks for taking my questions. So firstly, on the two OTC switches, where in development are you on those? Have you completed label comprehension or actual use studies there? And then secondly, could you frame the time frame for mid-term outlook for sales or margins and/or margins? So is that to 2026, 25, or perhaps something longer than that? And then on 2022 margins, you laid out all the offsetting factors. I know you can't give any explicit guidance, but perhaps you could just help understand whether those offsetting factors mean you expect margins to be higher or lower in 2022 over the 2021 base. Thank you.
Okay, thanks for the question. So on the two RxOTC switches, they're at different stages. What I would say is that we expect, again, if successful, would be 2025 and 2026. So that's the time frame we're looking on our RxOTC switches. We're excited about both. As I said, each would be roughly equivalent to about a point of growth on the business, and it is not in our medium-term 4 to 6% outlook guidance. The medium-term guidance is over the next few years, consistent with consumer companies and how consumer companies look at that medium-term guidance. On margin, and I'll turn to Tobias. I know Tobias took through some building blocks. What I'll just say is there's no change in the margin dynamic of this business as we look forward. And Tobias, maybe you can talk a bit more about how to think about the 22 margin.
Yeah, sure. So, I mean, as I said, I'm not going to give you a profit forecast for 2022, given the regulatory complexities in doing so, given the demerger process and the prospectus that is coming out. But as Brian said, I think, first of all, operationally, really no change in our margin dynamics. And you've seen over the last 3 years, as I laid out, the 325 basis points improvement in operating margin that we have driven. And as part of that, a 2 percentage point increase in operation leverage. And that was driven by investing A&P ahead of the rate of sales growth. And then that drove our 4.4% sales CAGR. So I think that we see to continue going forward. And so it's really about, I think, the three positive drivers are, first of all, it's volume and mix, and you've heard from all my colleagues today on the plans we have in order to drive further volume and mix improvement. And secondly, it's pricing. We've increased prices last year by 2.2%. We expect that number to be higher in 2022, given one, price increases that are underway, and secondly, the full year effect of a number of the price increases we took, particularly in Q4 in the US, as Lisa has laid out earlier today as well. And then thirdly, there's further supply chain efficiencies. As a reminder, we just integrated last year the Pfizer manufacturing sites and network. So as we've just done that, there is more work to do. And for us, making changes and getting efficiencies in supply chain takes a bit longer, given our business is highly regulated. So you would expect to see those improvements over a number of years. And then the two offsets against that are the higher the cost in the supply chain and the inflationary pressures. And as we said, us investing ahead of the rate of sales growth in both A&P and R&D. So I think that's the ongoing model that we would see going forward, both for next year and longer term. And then what's really new next year are two things. One is the incremental cost of running Haleon as a standalone publicly listed company. That is 175 to 200 million that you need to add, that will be added to the cost base for 2022. And that is then partially offset by the incremental synergies from Pfizer, which brings 120 million. So overall, I think continued very comfortable about our operating model and how we drive our margins both in the short and in the longer term.
Thank you, Tobias. We have another question from the platform. Can you say something about Haleon's culture and what will it differentiate it from GSK and other consumer companies? So first of all, as I said in my presentation, we define our culture with three behaviors: Go Beyond, which is all about outperforming the competition, performing on the business. So it's a real performance culture. Second is Do What Matters Most, which is all about focus and prioritization and doing the things that matter most for our consumers and customers and to drive growth on the business. And the third is Keep It Human. And that's all about the consumer centricity that we have as a business and also how we support each other from a culture perspective with our colleagues. So listen, I think we've had an opportunity over 2 integrations in the last 7 years to each time step back and say, define the culture that we wanted to create. We did that with the Pfizer integration, and we defined the culture we wanted to be. And I feel like we've created a distinct culture within GSK for this consumer business. But as we separate, we have another opportunity to accelerate that in those 3 areas, which is all about performance focus and consumer centricity. Okay. I'm trying to see, do we go to let's go to one more from the platform, sorry. What percentage of your sales do you expect to come from innovation annually? What is your year-over-year growth you expect going forward? So first of all, as we outlined and Frank and Tamara talked through, innovation is a key growth driver for us, and we have some great examples of how that drove growth and drove the penetration growth that we need that underpins our growth going forward. And Frank outlined our strategy. But Frank, maybe you can talk a little bit about how do we measure our innovation and how do you feel about the innovation going forward versus what we've done so far to date?
Yes, thanks, Brian. First of all, let me reinforce something which is very important. We have a competitive investment in R&D around 3%. And obviously, we track our innovation performance with different KPIs just to make sure we have some return on investment. And we believe we are competitive, and we expect even an increase from going forward with our current pipeline. We have a pipeline which is extremely solid and well-balanced between a short and long-term project and from between simple and complex projects. But more importantly is how this innovation fuels the growth of the company. And you have seen today, different presentation, some great example of how it has delivered some additional growth. Just 1 or 2 examples. So Lisa shared a great example with Sensodyne, and our innovation on Sensodyne the last 5 years helped us to gain market share from 17% to 20.5%. That's a great achievement with innovation, obviously. Another example I share with you was about Centrum in Australia, the new farm benefit platform. This is almost purely incremental. 83% of this innovation is incremental to the core business. So here again, that's just a couple of examples which showcase our competitiveness in terms of investment, always combining our deep human understanding and trusted science.
Okay, thanks, Frank. And maybe one thing I'd add is as we look at the innovation we've been able to do over the last few years, and we look at our going forward pipeline, we see more innovation coming than we've had in the past. We don't disclose our innovation as % of sales because it's all about driving growth on the business and obviously making sure that investment comes out. But we feel really good about our pipeline going forward and what we see in the future. We'll go back to the phone lines, please.
Our next question is coming from Celine Pannuti from JPM. Please go ahead.
Yes, good afternoon. Thank you. Sorry, the line dropped, but I had a follow-up question first on the margin one, which we didn't hear all you said, but my question was 200 basis points of operational excellence over the past 2 years, so 2019 to 21, post reinvestment. That's quite a spectacular level. It's 100 basis points per annum. You said that this will continue. Can you explain what are the drivers behind that? And when you say moderate margin expansion in the midterm, in some consumer goods company, they also use this language, and we interpret that as 10 to 20 basis point margin expansion per annum. Is that what you are aiming at? Then my second question is on the different drivers of growth that you mentioned in terms of category expansion, EMs, e-commerce, to which extent those are into new regions or new white space? I'm just wondering whether that means that there is a bit of a step up needed in investment in order to accelerate share gain if you are building, say, new geographies or if VMS is more competitive. Thank you.
Thank you for the question. So, Tobias, I'll go back to you on the margins, and then I'll come back on the of the drivers of growth, and Filippo, ask you to provide some perspective.
Good. So thanks, Celine. So when you look at the building blocks, so we've driven, as you said, 200 basis points of margin improvement, what we call from operating leverage over 2 years, so approximately 100 basis points each year. So that was driven by the sales growth, by the mix to higher margin brands, and then partially offset by incremental investment that we put into A&P. But I also said the A&P was only slightly ahead of the rate of sales growth, so it's something we want to accelerate also going forward. So I did not mean to say that it would be 100 basis points going forward in the future, because ultimately we want to go back to the model that we laid out, which is driving gross margin expansion and then investing ahead of the rate of sales growth in order to drive our sales and deliver 4 to 6% organic sales growth. Another driver, and a strong driver, was very strong cost discipline in the business, in addition to the synergies that we have lifted. And here we see, as Brian laid out earlier as well, some opportunities going forward as well. So after the step up in costs that we have from running the business independently, there could be some reduction over time as we go there. And then, Celine, on your second question about moderate margin expansion, so we're not going to define for you moderate margin expansion. I think just as a step back, we've driven significant margin expansion over the last few years. I think to a level where we believe our operating margin is top quartile in the industry. And I think for us it is a clear signal that we don't see the history continue. Also, given that what you've seen in the history, the synergies are running out. So we've delivered those, and I think we really want to move into this new model now that we laid out.
Thank you, Tobias. And on your questions on the drivers of growth and the geographic expansion, what I would say is, in the model that Tobias has shared and that we've talked about on a sustainable growth model, all the investment we need to drive that growth is in that model. So any portfolio expansion, geographic expansion is part of the model that you've seen. But maybe, Filippo, you can provide some perspective on some of those opportunities. And I know Centrum in Middle East Africa, for instance, is a big opportunity as we see it.
So hi, Selena. Maybe let me pick up 2 examples following what Brian said. So let me start by Middle East Africa as a geography. So as I have outlined in my presentation, despite having already leadership position in Middle East Africa, what is interesting is that 50% of our revenues are made by 2 brands, which are Sensodyne and Panadol. So this gives you a sense about what we can do to really leverage the footprint we have, the scale we have, in order to gain additional traction from the other brands we already have in the portfolio. Second, Brian alluded to Centrum. So here, so we have inherited the Centrum from the integration with Pfizer, and we have been growing the brand at 18% CAGR in the last years ahead of the market. But most importantly, if you consider that today 5 markets account for 60% of the Centrum revenue, so it's very much concentrated in few geographies. And the brand is present in 1 out of 3 of the markets we already operate in, which gives you a sense of why it is important for us to leverage scale and expand and leverage the footprint in order to make sure Centrum is a growth driver for the future. So I hope these 2 examples gave you a sense of what we mean by the possibilities behind the geography expansion and the brand expansion.
Thank you, Filippo. We'll go back to the phones for another question.
The next question is coming from Kerry Halford from Berenberg. Please proceed.
Thank you. A couple of questions for me, please. Firstly, on Geographic, can you tell us what proportion of Haleon sales are generated in Russia and Ukraine, what your exposure is there? And secondly, in the context of your plan to grow consumer R&D spend ahead of sales, and your aim to increase the returns on that R&D spend that you've highlighted, can you talk about what your consumer R&D returns have been in recent history? How do you measure that in consumer brands, and what your hurdle rate is, and perhaps how you compare versus the peer group? Thank you very much.
Okay, thank you, Kerry. On Russia, Ukraine, just for some perspective, Russia is roughly 2% of our sales and a similar level of our operating income. Ukraine is significantly smaller than that. And as we said earlier, our big focus for now is supporting our colleagues and employees and their safety in Ukraine. Tobias, do you want to talk a bit about how we think about R&D spend and making sure that we're getting the most out of it?
Yeah. So I mean, first of all, I think also looking forward, you've heard about the 2 Rx to OTC switches that we have in the pipeline. Those will go into trial phases. So there's money that support the development of those opportunities going forward. I think if I just take a step back, I mean, what we do is, I think, probably very similar, Kerry, what you're used to in pharmaceutical companies. We look at our pipeline, we look at every project, we look at what's the investment needed, what's the risk associated in the portfolio, and then have an NPV-driven approach on that. Now, what's might be a little bit different is, for us, I think we see innovation as a key driver for continued sales growth and also for pricing opportunities. We need to innovate, and if we bring new products to the shelf, that means we solve consumer needs that are unmet, but also secondly, we help our retailers to grow the category. And if we can do that, it gives us also pricing power and pricing ability. And it's a model that we've proven successfully in the past, and particularly when you look at the Sensodyne examples, we've continuously innovated, and that has allowed us also to take price on those products. So I think is a key driver of you invest behind the brand that's already there, but make the brand more and more valuable as you continue to build the brand for the future.
Thank you, Tobias. We'll take another question from the phone line.
Our next question is coming from John Ennis from Goldman Sachs. Please go ahead.
Hi, good afternoon, everyone. My first question is on the regional brands. You said that 60% of the portfolio drives 80% of your growth. So I guess the other 40% of sales, or the non-power brands, are effectively growing at around a 2% run rate in recent years. I guess, is this a reasonable expectation going forward, or can this accelerate? And is portfolio review a consideration to improve the performance there? And then my second question is on Sensodyne. I guess at a high level, why do you think that the sensitive toothpaste category hasn't been more aggressively exploited by other competitors? And on the 10-year CAGR you gave, can you decompose that 10% CAGR between market growth versus share gains, and give us a bit of a sense of the shape over the 10-year performance? Thank you.
Great. First on what we call local strategic brands and power brands. So what I would say is that we have local strategic brands, and we've talked about some of them, like Emergency in the US or Eno in Brazil and India. Every brand we have is not necessarily a local strategic brand, in the sense that Filippo in his region has many brands that are in pharmacies that have stable growth, very high gross margins, very little investment behind it. So there's brands in the portfolio that play a really key role. But we see a lot of growth opportunity in a lot of those local strategic brands, and obviously across the whole portfolio. Everything isn't growing at the rate of power brands, which have grown high single digits, and some of our local strategic brands that have been mid-single digits and sometimes double digits. On a portfolio review, as we've said, we have divested 50 growth dilutive brands in the last 18 months, and that gave us the proceeds of 1.1 billion pounds that we've talked about. Listen, we feel good about where the portfolio is at. We feel all the heavy lifting is done. Of course, we're always looking and reviewing to make sure that we're the right owner for these businesses and that the keep value makes more sense than the sell value, and we'll continue to do that and look at it. But we don't see a major sale program or a major portfolio shift that needs to happen. I think all the heavy lifting has been done and the portfolio is in great shape. On Sensodyne, this business has grown at 10% over the last 10 years, and globally in that time, the category has grown somewhere between 3 and 4%. We've been a key driver of that category growth because we're in therapeutic oral health. And I was going to ask Lisa in a minute to talk a little bit about the success story we have in the U.S., because I think it's a great example and to bring it to life for you. Others have gone after sensitivity. I want to be clear. Our two biggest competitors have offerings in sensitivity, and they've come after it. I think this is a great example of where our combination of understanding that consumer, that deep human understanding, and the science we bring behind it. And Frank talked a bit about what we do in order to really deliver on that sensitivity. That's what we're all about on Sensodyne, and we understand that better than anybody. And I think we've been able to do that. And another piece is really that dentist recommendation that we talked, where we are the #1 recommended toothpaste in over 70% of all the markets that we compete in. But Lisa, maybe you can give some perspective on Sensodyne growth over the last 5 years in the U.S., because I think it's a great success story.
Yeah, I think in the U.S. over the last 5 years, Sensodyne has grown a strong, double digit, about 10%. And we've seen that really work the flywheel that you've heard a lot about today. That is through this regular cadence of innovation, winning in the innovation that is actually incremental year upon year. Not easy to do, but has been, a very successful model. It's also about a mix between volume and price. We do continue to invest in the science behind these brands that help you get those professional recommendations, which then help you, make the additional claims and convert that to the trial. That's really critical to the long-term life cycle of the brand. And so we see a really effective, growth. We compete with two of the largest FMCG companies in this category. So it's not, that they're not interested, but it is that we are able to, punch above our weight, if you will, here in this category and have really owned this segment in the market.
Yeah, and in the last 7 years in the U.S., that brand has grown over 5 share points and growing share every year. So it really is a combination of net sales growth, but absolute share growth, outgrowing the category, and frankly, being a key growth driver of the category. We'll take another question from the phone.
Next up, we have David Hayes from Societe Generale. Please go ahead.
Thank you. Good afternoon also. So first thing to say, I've helped pay for the event because I did buy the Sensodyne Repair and Protect 50 millilitres tube during the call, because I was so sold on the video. So thank you for that. Just to pay for that, I guess, maybe I've got 3 questions if I can. First on online dynamics, the second one on the 4.4% growth, and the last one just on the process of the IPO. So on the first one, I think probably for Lisa again, I think you talked about 11 of the 16 brands in the US having higher market share online than offline. I just wonder whether you can sort of talk about what the 5 that aren't higher on with market share, and whether there's anything specific about those brands that stands out as to why that's a slightly different situation to the other 11 brands. On the 4.4% growth, just a clarification maybe. Obviously, you're not including in that 4.4, I think you said specifically, the dropout of the brands that you divested or stopped selling. But just so I understand, are you saying that they were still in the base of 4.4 and therefore now they've all gone? There's a benefit because they were all a drain and therefore there is a benefit in that dynamic, or is the 4.4 stripping it out altogether? And then the last one on the process, just to clarify, I think you said July, just to check whether it's July is the date or is it before July, so the latest of July. And then the question, which is probably unanswerable and maybe a bit naive, but just in terms of the process, are you still open to trade interest? Are you just going down this route still, or is there a view at GSK that whole thing's been explored now, and this is the route you're going to go down over the next few months? Thanks so much.
Okay, thank you for the question. I'll come to you, Lisa, after I answer the first two. So to be clear, on the 4.4%, that did exclude the brands divested and under review. And I think when I mentioned that earlier, it was more of looking at the historical performance, why the last 2 years are most relevant. Because in the last 2 years, we've had this portfolio that we're going to take forward as Haleon. As far as the IPO, well, the demerger date is July, and absolutely July is the date, and we've said that, so there's no plan to do anything earlier. Listen, on the trade interest, what I can say is this team, as you can see today, is 100% focused on the demerger of this business. We believe it is an attractive opportunity with great brands and a fantastic geographic footprint, great capabilities, the right strategy to win, and a really strong outlook and a sustainable model to drive growth. So that's where our focus is. Of course, if there's any other interest, the GSK board would need to do their fiduciary responsibility and look at that, but it's not something that this team is spending any time thinking about, as we're really excited about the opportunity in front of us. And Lisa, maybe we'll ask about the 11 of 16 brands, but one piece of perspective on the U.S. business is, as we've shared in the presentation, our penetration in the U.S. is at 12%. And we look at the penetration in the U.S. across the categories we compete, that's more at 9%, it's around 9%. So we are actually disproportionately overall winning. Obviously, some are better, and there are some brands that aren't as strong. But maybe, Lisa, you want to start with some of the brands where we do particularly well and provide additional perspective.
Yeah, for certain. So as we mentioned, this is a key part of our core strategy as we elevate the consumer's experience through digital commerce. And we have really won market shares extensively, for example, on paste. And that's a very tough competitive category. So that's someplace where we've disproportionately been winning. We also have had very good success with smokers' health category, and likewise, brands like Flonase online, where people are chronically suffering, and they like the ability to stock up and to do different things there. So I think, we are really pleased with those results. I think what we are also signaling is we remain bullish on our continued growth opportunity here. And what you're poking at a little bit, I think, is where else do you have room to grow? And I think it'll answer part of your question. So if we think about vitamins, it's very proliferated online. And so we continue to have opportunity on Centrum, just given the larger number of competitors overall. And so we're taking the appropriate steps to be competitive in that environment online and continue to win. And then the other two are maybe less obvious, but cough cold is an immediate needs situation. And so what you need is to be able to get products really fast. So as delivery options become available, we think that's another space that opens up and makes that quite attractive for online purchasing as well. And some ingredient things, that we're managing there. The second and final one that I'll share with you is really around dentures. Brian mentioned a few of the behaviors, but this is primarily an older demographic, and they've had mixed comfort with being able to shift and buy online. They've gotten better, during the COVID experiences, and we are working with them to also help make them comfortable on where to buy their purchases.
Thank you, Lisa. We'll go back to a question from the platform. Can you please give more color on working capital as a % of sales, and how do you expect it may trend, and do you use factoring? Second question, separately on ESG, why is there no net zero target? So Tobias, why don't we start with the first question to you?
Good. Yeah. Thanks, Brian. So first of all, on the working capital. So if you take a very strict definition of working capital, which is inventory, accounts receivable minus payables, then our working capital is less than 10% of revenue. And as I laid out in my presentation, we see more room for improvement, especially on the inventory side, given that we predominantly focused on integrating the business over the last few years. So that's, I think, again, very sort of strict definition of working capital in the purest form. And then on factoring, we use it, but we only use it where it has a return, given where there's a high risk, and where actually factoring has a positive return. But I think it's a very small part of our receivable management.
Thank you, Tobias. And on ESG, why is there no net zero target? And I'll turn to Terry in a moment. But again, just as a reminder, our current carbon footprint is significantly lower than many of our peers, as Terry talked in her presentation. And we do have a target for a reduction of that carbon footprint, scope 1, 2, and 3 by 2030. But Terry, do you want to talk a little bit about our net zero and why we don't have a target today?
Yeah. So, Brian, just to reiterate, we do have targets for 2030. We have taken a target of reducing 100% our scope 1 and 2 carbon footprint and reducing by 42% our scope 3 footprint by 2030. And these are very much in line with the 1.5 degree pathway that's been laid out by the Science Based Targets Initiative. And it's our intention, as soon as we become a standalone company, to begin conversations with the group, the Science Based Targets Initiatives group, to begin to define our 2040 net zero goal. Following the COP26 discussions, there was quite a bit of nuance and change brought forward about how one should interpret a net zero carbon target. So we want to make sure, once we're a standalone entity, that we'll have those conversations and we come out with a target that is appropriate for the nuances that have come forward.
Thank you, Terry. We'll go back to the phones.
Our next question is coming from Kia Parekh from Goldman Sachs. Please go ahead.
Hi, good afternoon, and hopefully you guys can hear me okay. 3 questions, if I may, please. The first one is for you, Brian. Kind of at a big kind of picture level, it seems like a couple of the other pharma peers are following kind of your footsteps and kind of trying to separate the consumer health businesses. So my question for you would be that as you see the broader strategic landscape kind of for consumer health over the next 3 to 5 years, how do you see opportunity for Haleon to play a much bigger role kind of in that space, given how fragmented it is today? So that's kind of question number 1. Question number 2 would be kind of for Tobias, and which is just trying to get a bit more granularity around the outlook for margins. If we were to assume that the starting margins in 2022 is broadly similar to that in 21, with kind of the puts and takes on kind of synergy versus separation cost or one-time cost on that, how comfortable are you with the margin progression that the Glaxo covering analyst had built in for the consumer health businesses? I think those numbers were in kind of 40, 50 basis points per year range. So how comfortable are you with that? And then the third question is, as we looked at kind of your power brands, they're clearly kind of growing now at 58% of your business, contributing to a lot of the growth. Is there anything you can share about the level of profitability associated with those power brands? And consequently, as we see both kind of the top line growth going forward and margin progression, how much lesser of a drag will be the less growing part of your business be? Thank you.
Okay, thank you. And Tobias, I'll come to you on the second 2 questions. Kaya, on the question on big picture. So, yeah, we have seen the announcement that J&J has decided to also separate and become an independent listed company in the U.S. I think it just is a reinforcement of the strategy that GSK has had, and certainly a reinforcement of the attractiveness of these assets. And certainly it is a fragmented category, and certainly in OTC and in VMS. And I think, as I outlined, as we sit here today, we love the portfolio we have. We don't need to do M&A to do those, to deliver the commitments that we made today. We do have capacity over the next couple of years to do bolt-on M&A if attractive and fits with us strategically and accelerates our growth. And I'm not going to predict on what's going to happen in the future and what assets will come up. But certainly we see ourselves as a business that has proven the ability to do big deals and to integrate businesses. But right now our focus is on the organic growth, separating this business and delivering on the commitments we've laid out today. Tobias, on the outlook, but also on the power brand mix and margin.
Yeah, good. Thanks, Brian. So first of all, I think when you look at the margin expansion, I said for 22, I'm not going to give you a profit forecast, and then we said from 22 on, we said moderate margin expansion on an annual base, and we don't want to define what that margin expansion is because we do not have a margin target in mind. We believe that the margin we have is top quartile of the industry, and I think we've worked hard over the last 2 years getting to this place, and I feel really proud what we achieved as a team, getting to the margin where it is today. So what we want to do going forward is invest in a disciplined way on A&P and R&D ahead of the rate of sales growth. And that coupled with gross margin increases, with all the drivers I mentioned earlier, should allow us, in addition with other SG&A reducing, given the scale we have and the optimization opportunities there, a moderate margin expansion in the longer term. And I'm very confident we can deliver that. Yeah? And then I think on the power brands, so I think the power brands ultimately it's a scale question. So the large power brands have scale, so that means we get the economies of scale in that. I think both from a manufacturing point of view, but also from an A&P point of view, and we're building on these. Again, I think we take very, very conscious choices to invest in them if we see growth opportunities, and you heard a lot of them today from all my 3 region colleagues, that we would go and invest even more in that if we can drive higher household penetration and other opportunities. So I think from that perspective, growth potential there, but ultimately all coming back to the model of driving sustainable 4 to 6% annual organic sales growth.
Great. So we have time for 2 more questions. We'll go 1 more to the phone. We'll take the last one from the platform. So let's go to the phone.
The last question from the line is from Emmanuel Papadakis from Deutsche Bank. Please go ahead.
Thanks for taking the question. Perhaps I'll take a couple on the e-commerce digital side. I wonder if you could give us a little more detail on the mix of the 8% of e-commerce channel sales. And what I mean by that is how much, if any, is direct-to-consumer versus third-party platforms, and what's the mix in terms of online retailers like Amazon versus online grocery, pharmacy platforms like Walmart, Walgreens. What's the risk, I guess I'm asking, of concentration or consolidation around platforms like Amazon? And as part of that, I'd be very keen to understand your perspective on the future risks from private label as that consolidation potentially takes place. And then perhaps if I could, just on the margin outlook, what input inflation cost assumptions have you made beyond 22 in your margin guidance? It sounds like the plans for an even mix of pricing and volume to drive that 4 to 6% sales CAGR. So how is that pricing growth spread across regions? Is it pretty evenly distributed, or are you really looking at certain regions to drive pricing as well? Thank you very much.
So thank you for the questions, and Tobias, I'll come to you back on the margin question. But on e-commerce, the mix. So first question was the mix of through customer channels like Amazon or retailer e-commerce sites versus direct to consumer. The vast majority of our sales is through customers and third party. We do have some direct to consumer businesses, and Lisa talked a bit in her U.S. presentation about Chapstick and a direct-to-consumer business we have there, which is going really well, and it's a platform that we're looking at expanding. But I would say that it's not a key driver of that e-commerce sales that you've seen, but we're going to see how that channel plays out. We've certainly been successful where we have done that work. The other piece is you look across each Amazon versus omni-channel. Probably a good place to look at that is in the U.S. business, where it's about 70% coming from Amazon, 30% coming from omni-channel. And frankly, the growth in the omni-channel retailers, the Walmarts and the Walgreens and CVS's and the Targets, is actually quite fast, and we're doing quite well there. So we're seeing that shift balance out a little more as it goes. And then on private label, listen, we've been competing with private label for 50 years in markets like the U.S. and in the U.K. So, it's a dynamic we will manage online like we manage offline. And what we find out in competing with private label is there is a place for private label. There's no question about it. But in healthcare and where we play, brands really matter. Trust really matters. And what we say is we can win in a world of private label if we innovate and we do the right thing on consumer connections and we deliver the benefits that consumers are really looking for. And then Tobias, maybe the question on inflation and your thoughts on margin.
Yeah. So first of all, I think when you look back on how we've managed inflation, I think last year we guided that we would see that about 50% of the inflation costs we would mitigate through cost efficiency in the supply chain and the other 50% via pricing. And we've done this successfully. As you've seen, our gross margin increase already last year, so 21 versus 20, actually both years, 19 to 20 and 20 to 21 as well. So I think that gives us confidence. And that's also what we were targeting going forward, that we mitigate inflationary headwinds through a mix of pricing and efficiencies that we drive in the business. So I think I'm confident we can continue doing that going forward. And then I think, Emmanuel, you also asked about across the regions. I think the contribution from the regions is probably fairly evenly split. Of course, you would expect in an emerging market environment where inflation is higher, you would look for a bit more price increase. But I think this is really a country by country, and then not just a country by country, but a product by product approach where we look very, very detailed by where are we? Are we priced competitively? What opportunities do we have? So I think we don't take a broad brush approach here, but really do that in a very, very targeted manner across all of our businesses.
Thank you, Tobias. So to the last question from the platform, how will management be incentivized, short-term and long-term KPIs and weight? And if you can't share, what are the key considerations? Well, as you would imagine, that the incentivization is a matter for the new Haleon board and the new Haleon Remco. And that's work that's coming, and you would see our Remco policy, remuneration policy in the prospectus. But what I would say is fully expect that the incentivization for this management team will be very closely linked to all the commitments we've made today on growth, on moderate margin expansion, on cash flow, on deleverage commitments, on ESG commitments. So, more to come, and we'll share that when we have it. But that would be the considerations and what you can expect. Okay, thank you. So listen, I hope after spending 4+ hours with this group of folks today, that you're as excited as we are about the opportunities in front of us. This is an amazing business. It's got an exceptional portfolio of brands, category-leading positions. We have really strong capabilities that we've built over the last few years. We have a strategy to outperform. We have clear building blocks on how we're going to deliver ultimately our growth outlooks, which is 4 to 6% annual organic sales growth, moderate margin expansion, with strong cash conversion and the deleverage commitments we've made. We are super excited about what the future holds for us, and we're looking forward to engaging you a lot more in the coming weeks and months as we lead up to separation. So thank you for your time today.